I've known Asia Partners for several years, and I had Nick Nash, one of the co-founders of the firm, on Squawk Box a few years ago. Well, Nick has lived in Singapore with his family since 2011 and hasn't just had a front row seat to Southeast Asia's tech ecosystem, he's been right on the court. From 2014 to 2018, he was the group president of Sea Limited, which is today Southeast Asia's largest publicly traded internet company, with a $27 billion market cap in January of 2023. Nick led Sea's landmark IPO on the New York Stock Exchange in 2017, which raised just under $1 billion in capital for the company. Now, despite all the ups and downs of the markets in the past few years, Sea has been one of the world's best performing tech IPOs of the past 6 years. And Sea alumni are now ubiquitous across Southeast Asia, founding and leading new companies. Before joining Sea, Nick had spent a decade at General Atlantic, one of the world's largest private equity firms, where he co-founded and then ran their Singapore office. A little more than a year after Sea's IPO, Nick co-founded Asia Partners to return to his investing roots and, in his words, help to support the next generation of Seas across the region. Nick, let's get into it. As an investor, what is the case for Southeast Asia?
That's exactly the question General Atlantic asked me to figure out when they sent me here from New York back in 2011. The last 12 years living here have really helped for me to bring this question into sharper focus. Let's start with the region's track record. 2022 was a very challenging year for public market equities. Almost all of the world's stock markets suffered losses, but a handful managed to preserve value or even increase. Thailand, the second largest economy in Southeast Asia, was one of them. Its index actually grew 2% in US dollar terms. Singapore was flat, which was a real accomplishment in a year like 2022, and Indonesia fell only 4% in US dollar terms. In contrast, the Bloomberg index for mid and large cap US stocks was down 21% in 2022. In fact, 5 out of the 6 major economies of Southeast Asia outperformed the US in 22 in dollar terms. It's worth mentioning that Vietnam did not. In fact, it was among the world's worst performing markets that year, and that's despite very strong GDP growth.
But that was a one-off. After all, that's just a single year we're talking about.
You're absolutely right. It's important to take a longer perspective. If you go back to the beginning of the century, the year 2000, and roll forward equity returns from then through 2022, Southeast Asia again does fairly well. On the left-hand side, you can see the absolute IRR, or annual returns, by country over the past 22 years. Thailand and Indonesia, which are the 2 largest economies in our region, did exceptionally well. And this is again in US dollar terms. They each outperformed the US markets by several hundred basis points. The Philippines also had a strong showing, outperforming the US by over 100 basis points. Those are on the positive side of the ledger. To be fair and balanced, it's worth pointing out that Singapore, Vietnam, and Malaysia each underperformed US equities by between 100 and 150 basis points, though they did each have a positive return in absolute terms. That's an important topic my colleague Friska will shed some light on later in this film.
Okay, but returns by themselves, even if they're positive and better than the US market, only tell part of the story. If you're only getting, say, just 140 basis points above the US, which is essentially what the Philippines have yielded, why bother?
It's the right question. The key dimension we're still missing is considering diversification. Now, I'm not suggesting that you should invest in a market that has negative returns just because it isn't correlated with the US. But if you look at our market, a lot of the markets that have had positive alpha to the US markets also have fairly low correlations to the US markets. That's a good thing. We like to look at both of these data sets synthesized together, which is this chart. In an ideal world, you'd have a positive IRR, and ideally well above that of the US, which has been just below 5% for the past 22 years, and you'd have a low correlation to the US markets, meaning you would zig when America's stock market zags, so to speak. That means closer to the lower right-hand side of this chart, the green direction, and away from the upper left, which is the red direction. On that basis, Indonesia and Thailand again really shine. In fact, on this holistic basis, the entire region is actually quite interesting, assuming that the bulk of your existing portfolio is tilted towards US equities, as is the case for most of the world's largest institutional investors. The other interesting lens has been how Southeast Asia has handled the recent global surge in inflation. We'll talk more about it later on, but for now, let me share this. In a world which had challenging GDP growth and high inflation in 2022, the classic stagflation recipe of the 1970s, it's remarkable that 3 out of the 6 economies in Southeast Asia had real GDP growth higher than inflation. Almost all of the rest of the world fell into the red zone on this chart, with the opposite taking place. Inflation was higher than GDP growth.
Talking about inflation, though, brings up the perennial worry that investors have about emerging markets. That is the drag from FX. How do you think about that in your region?
We're always puzzled when folks look at FX changes in isolation from inflation. In our mind, they're sort of two sides of the same coin. If you have a higher inflation rate than the US, all else equal, and there often are balance of payments and trade surplus dynamics as well, you ought to have a parallel erosion in your FX rate versus the dollar. If we look at the last 2 decades, and just for a moment, since final year 22 numbers aren't in yet, let's look at 2000 to 2021. The US had 2.1% average inflation, and of course, the FX rate didn't change versus the dollar. It is the dollar. Now let's look at Singapore, which is about a third of the way down the chart. Singapore's inflation was actually lower at 1.3%, so it's not surprising that its currency actually appreciated against the dollar. The result was a 2.4% total net effect, which was actually slightly higher than US inflation, meaning in very practical terms, if you held the Singapore economy but measured yourself in US dollars, you were actually slightly ahead, which is what you see in the rightmost column. Let's look at another example, say Indonesia. Indonesia ran a much higher inflation rate versus the US over that period of time. So you'd expect to see its currency erode. It did. But on a net basis, you actually had a total of 5.4% in dollar terms, which was 3.2% higher than US inflation. It means that you actually got paid for holding the Indonesian economy when measured in US dollar terms, just like Singapore, but even more so. In fact, that dynamic obtains for all 6 of the major economies of Southeast Asia in varying degree, which you can see highlighted across the page in yellow. That's not necessarily common around the world. These dynamics actually worked against you in the UK, Hong Kong, and Japan, as you can see from the red bars at the far right. But they were a useful and quiet source of alpha for US-denominated investors in Southeast Asia over the past 20 or so years. Of course, there's no guarantee that will continue, but it's still very interesting to see.
But we did skip 2022, and that was such an important year.
Totally. I am very interested to see what the net effect of FX and inflation will be once we have the final numbers in. What we can say, looking at just one side of the coin, was that 5 out of our 6 economies did have FX depreciation versus the dollar. The Singapore dollar, consistent with 2000 to 21, actually appreciated versus the dollar, but the other 5 did not. This isn't to exculpate any of the currencies from depreciating, but if you look at how they did versus the euro's depreciation, 4 out of the 6 actually depreciated less against the US dollar than the euro. And needless to say, they all did much better than the yen, which lost 12% against the dollar in 2022. It was a great time to go on holiday in Japan if you had US dollars.
Understood, but this really has all been backward looking so far. So what about the future? What can you tell us?
Well, as more than one person has said, it's hard to make predictions, especially about the future. Why don't we start with what the IMF has to say? They don't always get it right, no one ever does, especially in a recession year, but it is an interesting starting point for conversation. We pay a lot more attention to nominal growth in US dollars because that's apples to apples with ultimate equity IRRs. And on that basis, in the past 5 years, China was the fastest growing economy in Asia, again in nominal dollars. Over the next 5 years, the IMF thinks it will fall a few notches down, with Vietnam and Indonesia each growing faster. And that's not to take away from the rest of Southeast Asia, all of which are forecasted to grow faster than the US, Germany, and Japan. That's a major change from the China centricity of the past decade. But needless to say, economic forecasts are just forecasts. What's a lot more dependable is demographics. Let me put it this way. The world has 29 countries with at least 50 million people. 6 of them have flat or shrinking populations over the next 5 years. Almost nothing can change that. What's very special about Southeast Asia is that out of the remaining 23 that are growing, we're home to 4 of them. And many of the others in the 23 are truly frontier markets and in some cases even arguably uninvestable. In contrast, the largest population countries in North Asia and East Asia, which have certainly gotten a lot of investor attention over the past 50 years, are all falling. That's happening already. It's happening now. What that means in practice is that Southeast Asia, and this includes some of the smaller countries, less than 50 million, although Malaysia's 34 million is more than all of Texas, is really driving Asia's population growth in the next 5 years. In fact, the IMF estimates that 3 out of our countries will have an even higher rate of population growth than even India, even though they're actually more affluent on a per capita basis. There are many ways you can take useful cuts out of demographic data to analyze them. And the one that we find particularly revealing is to look at just the number of 15 to 35-year-olds. That age band is very important for tech product adoption, and it's a leading indicator of the size of the workforce in the near future. On that basis, Japan, Korea, China, and Taiwan all peaked in the 1990s. Not a few years ago, in the 1990s. India is expected to peak in 2026, in basically 3 years. Southeast Asia holds out the longest, with a peak in 2031. That says a lot about Asia's future in one chart. And if you unpack Southeast Asia's curve, you see a few interesting things. The ongoing demographic expansion is coming from the 2 largest countries by population, not just because they're big, but more importantly because they're still young. In contrast, Malaysia peaked in 2019, Singapore in 2016, Thailand back in 1995. The fact that the Philippines only peaks in terms of the number of 15 to 35-year-olds around 2055 is a hugely important fact. All of these underlying data points set the stage for what we think is one of the most interesting opportunities, the build out of a fully fleshed out tech ecosystem in our region, following in the footsteps of China, Korea, and Japan beforehand.